great transport links. Trains to London in just over 2 hours. It's affordable compared to the south, with average prices around £230,000, yet demand keeps rising. Higher yields, lower prices, and a chance to ride the wave of regeneration. In London, prices have risen 83% since 2010, but incomes haven't kept up. In the north, there's more room for growth because prices are still reasonable compared to wages. Hello everyone, welcome back to the channel. Today we're diving into something I've been thinking about a lot lately: emerging markets in the UK property scene. These are the areas that are starting to show real promise for investors, and I thought I'll walk you through a few places we're watching, why they matter, and what the numbers are telling us. So let's get started. When we talk about emerging markets in property, we mean places that are quietly growing, areas where prices are still affordable, demand is picking up, and there's something happening, like new investments going in, more jobs, or better transport. These are not the usual suspects like London. Instead, they are cities and towns with potential. Let's look at a few and break it down step by step. First up, let's talk about Manchester. Now, Manchester been on the rise for a while, but it's still got room to grow. The numbers back this up. Property prices in the northwest, where Manchester sits, are expected to climb by about 19% between 2025 and 2029, according to Savills. That's a steady increase, not a wild jump. Why? The city's economy is buzzing. Tech, finance, media, it's all happening there. And with rental yields around 6% in places like One Port Street, it's pulling in investors who want solid returns without breaking the bank. So what's driving this? Regeneration is a big part. Projects like the Victoria Quarter are adding new homes and jobs. Plus, Manchester's got great transport links. Trains to London in just over 2 hours. It's affordable compared to the south, with average prices around £230,000, yet demand keeps rising. It's a sensible choice for anyone looking at long-term growth. Next, let's head to Birmingham. This city is often called the UK's second city, and for good reason. Over the past 5 years, new apartment prices here have gone up by nearly 15%. It's an upward trend. Birmingham's rental market is strong too, with forecasts showing a 22% rise in rental values between 2024 and 2028. That's one of the highest in the country. So what's behind it? HS2 is the big one. This high-speed rail project will cut travel time to London to just under an hour, making Birmingham even more connected. Add in affordable property prices, around £258,000 on average, and you've got a place that's drawing in young professionals and families. Developments like Addition Birmingham are tapping into that, offering premium rentals for a growing workforce. It's steady, it's reliable, and it's worth watching. Now let's move to Liverpool, another gem in the northwest. This city's got a lot going for it. Average property prices are around £180,000, well below the UK average of £268,000. But don't let that low entry point fool you. Rental yields here can hit 7% or more, especially near the city centre. So what's driving this? Liverpool has had a revival. The docks and waterfront areas have seen over £5 billion in investment since 2000. Turning old industrial zones into vibrant hubs. The economy is growing too. Think creative industries, tourism, and a student population of over 70,000. Projects like Liverpool Waters are adding thousands of new homes, keeping demand steady. For investors, it's simple: low costs, high returns, and a city with momentum. Another spot we are keeping an eye on is Leeds, up in West Yorkshire. This city's got a lot going for it. Average property prices are around £230,000, still well below the national average, but what's exciting is the growth. Leeds has seen house prices rise by about 4.5% in the last year alone, and rental yields in the city centre can reach 7%. So what's fueling this? Leeds is a powerhouse for business. Finance, legal services, and digital tech are thriving here. It's home to over 30,000 students too, which keep rental demand steady. Big projects like South Bank regeneration are doubling the size of the city centre with new homes and offices. It's affordable, it's connected. Trains to London take about 2 hours, and it's growing without the hype. That's why it's on our list. Let's pull back for a moment and think about why these areas matter. The UK property market in 2025 isn't about chasing the next big boom, it's about finding steady growth. House prices across the country are set to rise by about 2.5% this year according to Zoopla, and that is modest, but it's the reality. And in emerging markets, you often get more for your money. Higher yields, lower prices, and a chance to ride the wave of regeneration. Take the North-South divide for example. The Northwest, where Manchester and Liverpool are, saw house prices climb faster than London last year. Places like Birmingham and Leeds are outpacing the South too. Why? Affordability. In London, prices have risen 83% since 2010, but incomes haven't kept up. In the North, there's more room for growth because prices are still reasonable compared to wages. So, what does this mean for you? If you're an investor, these areas offer a balance. Decent returns now and potential for appreciation later. If you are a buyer, there are places where your money goes further. And for landlords, the rental demand, especially for students and young professionals, is a steady foundation. Now, it's not all smooth sailing. Interest rates are still a factor, expected to settle around 4% by mid-2025. That's better than last year, but it's not dirt cheap. And in some areas, regeneration projects can take time to pay off. But that's why we are watching these spots closely with data in hand and not rushing in blind. That's it for today. Manchester, Birmingham, Liverpool, Leeds, these are the UK areas we are watching, and they matter because they are growing sensibly. If you're curious about property investment or just want to chat about these trends, drop a comment below. I'd love to hear your thoughts. And if you found this helpful, give it a thumbs up and subscribe for more. Until next time, take care and happy investing. Bye bye!